My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth. We're bringing them down very substantially, even from the original Trump tax cuts.
That was President Trump promising tax cuts while speaking at the World Economic Forum in Davos, Switzerland, to the World Economic Forum in Davos, Switzerland. But he needs Congress to make that happen. Joining us now to talk about the path ahead, let's bring in Illinois Congressman Sean Casten. Congressman, it's great to have you here on Yahoo Finance. I'm going to guess that you're probably opposed to some of the tax cuts efforts that have been proposed here over the last several months, some of the policies that we've heard from President Trump. But I'm curious just in regards to the corporate tax cuts. How are you viewing just the argument that that would substantially really help U.S. competitiveness here on a global scale?
It's hard to make that argument, but let's review back to what happened during the last set of Trump tax cuts. We know it's been said many times that 80% of those tax cuts went to the wealthiest Americans. But what we also know is that when we brought in the global minimum tax, under the Biden administration, all of a sudden the U.S. became a tax haven. And so you've got a bunch of tax lawyers right now who are trying to find ways to help corporations who had intentionally domiciled their companies to recognize their taxes overseas, trying to bring them back to the United States. We already effectively are the lowest tax rate in the world. So we're not doing anything beyond that of just transferring wealth. I would also point out that under Trump's last term, Trump's IRS director told us that we were giving up nearly $1 trillion a year in revenue because we underfunded the IRS, and we were failing to collect taxes due under the current tax law. So we funded the IRS, and of course the Republicans started to pull that back. But the question of what the marginal tax rate is entirely separate from what is the tax that we actually collect. And I think what frustrates a lot of my Democratic colleagues is we can talk about this in some economic theory, but then separately, if we're not going to enforce the laws we have, this is fund the police, for goodness sake. So I think we're all very concerned about the scale of the tax cuts they want, the deficit impacts this is going to have, and the argument that this will grow the economy is simply not borne out by any macroeconomic statistics.
Well, certainly a big concern for voters is inflation. That was cited as the number one issue for voters on exit polling this election cycle. The corporate tax cuts could be seen as an inflation hedge because without them, corporations could raise prices in order to fund their ability to pay off those taxes. What do you say about the risk of that?
So that argument presumes that inflation was limited to the United States. Inflation was global. The United States actually had slower inflation than most of the rest of the OECD. I was on a bipartisan CODEL to Europe just before the election, and every single European country was jealous of what the United States had accomplished in the wake of all the inflation that happened during COVID. And of course, they were all also saying that their voters voted against the incumbent party because everybody blames the incumbent when inflation happens. The fact that we have brought inflation down faster than the rest of the OECD, and the fact that we have a lower marginal tax rate than the rest of the OECD, means that on the margin, lowering U.S. taxes doesn't actually do anything that's anti-inflationary. The stuff that was really making a difference on the anti-inflationary side, and this is politically unpopular maybe, but it doesn't make it true. The CBO reported that one of the big reasons the U.S. got inflation under control faster than other countries was because we had such higher immigration rates to the United States. And that was allowing us to create jobs without creating as much upward wage pressure as was happening in other countries. Trump's clamping back on that as well, right? Mm-hmm. And these shouldn't be partisan. These are like objective macroeconomic facts. But taxes are not the solution to all problems and rarely are the cause of all problems, candidly.
All right. Well, we don't have a ton of time, so I want to switch gears and I want to talk about energy. President Trump talking about drill, baby, drill this week. Here's what he had to say at the World Economic Forum.
We need double the energy we currently have in the United States. Can you imagine? For AI to really be as big as we want to have it, because it's it'll be very competitive with China and others. So I'm going to give emergency declarations so that they can start building them almost immediately.
And I know you just sponsored a bill aimed at improving interregional electricity transference, and this could help maintain the reliability of the grid. Does your end goal when it comes to increasing the reliability of the grid sort of align with President Trump's?
Well, it does, but we need to speak very clearly about energy. I was talking with one of my colleagues this week that if we asked an agriculture secretary what they're doing about hunger, and they said we're planting more corn, we would realize that was ducking the question. When you ask what you're doing to give people affordable, reliable energy, and we say we're going to drill, that's the same. We're shifting to the upstream end of the equation. What we need to be doing is making sure that as we have seen this surge in domestic manufacturing over the last 4 years, as we've seen the surge in AI, as we've seen electrification of the transportation sector, we need to build a much more resilient grid, and we need to make sure that that's providing ways where the lowest cost power can get to the highest demand nodes, which means building out the transmission system. That's very different from what Trump is saying, because what Trump is saying is, I want to focus on the upside, drilling assets. The oil and gas industry is increasingly an export play in the United States. The oil demand in the U.S. is basically flat over the last decade. Oil production is up and it's moving to export. Natural gas is rising, but not rising as fast as GDP, and natural gas exports are surging. So you've got an industry that really wants to build export terminals, not provide energy for Americans. And then separately, you've got energy that can't be shipped, wind, solar, that needs transmission to get to customers. And we're seeing Trump saying that he's going to ban offshore wind. Mm-hmm. And so I think we really need to understand this, that if we are focused on a pro-consumer energy policy, then we have a lot of constructive areas we can work with the White House. If we are focused on saying we want to benefit producers at the expense of consumers, we need to be honest about that, and I think we need to stand in defense of consumers.
All right, Congressman, thanks for joining us. Appreciate it.
Thank you very much.
Increasing oil and energy production, of course, a major focus for President Trump. Here's what he said about oil at the World Economic Forum.
The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto.
We've seen oil and gas moving to the downside off of those comments this week. Prices recovering towards the end of the week, but oil still set for its first weekly drop of the year. For more on what Trump's energy plans mean for investors, I want to bring in Paul Sankey, Sankey Research Lead Analyst. Paul, great to have you in studio. I want to get your take on energy producers, because Trump doesn't necessarily control what these individual companies do as much as he might like to. What are you anticipating the reaction to look like from those individual companies?
Not a lot. I mean, at the moment, we can't see how drill, baby, drill can be applied to those companies because they're private and because analysts like me, but more importantly, shareholders, are really very closely watching these companies to make sure they don't overspend and they don't increase spending into what looks like a quite oversupplied oil market, generally speaking. And that folds through into Trump's other comments towards the Saudis, because obviously it's difficult for the Saudis to want to lower oil prices when their budget balance is probably more like $90 a barrel and we're below 80. So there's a few internal inconsistencies here that sort of just don't hang together, quite frankly.
Well, does the rhetoric coming from the White House, from the Trump administration so far, does that put any sort of ceiling or cap to the upside here on oil prices, or what we're likely to see over the next couple of years?
I would say it's definitely disconcerting that they keep talking about lower oil prices and lower. I mean, the president keeps saying, let's get prices lower. It's hard to ignore it, you know. And of course, there's a very specific concern about pump gasoline prices. And then at the same time, you've got things like the tariff threat from Canada and Mexico being, certainly Canada, our biggest oil supplier. Oil that we also can't replace. You know, this is heavy sour oil that the mid-con refiners can't just turn around and use other oil. So that would, have that's a directly, opposing internal inconsistency. Over time, I think it'll come down to the demand side. So the biggest question is, do you put these tariffs in? Are they inflationary? Probably not. Is the pro-business environment going to be good for the economy? And then does that lead to strong demand? The worry there immediately becomes China, right? Because you've got, the potential for tariffs on China and the weakness of China as being a problem. So it's really conflicting. There's not a simple answer. They want lower prices, but a lot of what they're saying and doing would mean higher prices. And in amongst all that, the companies are sort of just watching with their arms folded. They're not really doing anything. So it's a confusing environment. And as you know, a lot of these executive orders are just executive orders. They don't actually do anything immediately. So it's very much a rhetorical environment. The final answer, we're somewhat bullish here. Basically, with winter, we've got strong demand. One of the real surprises was that the Biden administration put much, much stronger sanctions on Russia and Iran right as they ended, which is kind of, can't really fully understand that, but it definitely plays into Trump's negotiating position. So I think we're anticipating a tough stance on Russia and Iran, much more so on Russia than we would have thought 3 or 4 months ago when the market started first discounting a Trump win. So we'll watch those two. Those are the two key supply side ones more than the drill baby drill.
And are they more key than any potential tariff risk with regards to China, like you mentioned?
Yeah, I mean, it's just so hard because you're just bouncing around. I think yesterday Trump was backing off China tariffs, but he's been saying so repeatedly tariffs, it's hard not to believe there's going to be some. What we heard from lobbyists in Washington, and the lobbyists love the Republicans and particularly love Trump, is it's very good business for them because in their particular business, and this is one specific lobbyist, they had applied for exemptions on tariffs and had an 85% success rate for their clients. So the phase after the tariffs are imposed is everybody rushes to get a meeting to get an exemption. So, the extent to which you can capitalize any of this into equity values, that's our issue as stock analysts, is, it's almost like just shut your ears and wait. Because, there's nothing really truly coming out of it right now other than rhetoric.
Well, how should investors then be reading, I guess, just a bit further into it? Well, given the circumstances, given that uncertainty, given where things stand and what we know about Trump's policies and what he wants from a drilling perspective, who then is best positioned among your coverage?
Yeah, that's exactly how we look at it. So you stay thematic and you go, okay, well, look, who are the obvious winners? And the obvious winners for us, and we cover high capital intensity businesses, is obviously this AI theme and the investment that's going into that, because the amount of money and the scale of the companies, these companies of this scale have never previously existed, much less with the ability to spend this much. And the sheer numbers that they're talking about in the hundreds of billions a year obviously is going to need an absolutely enormous amount of US electricity, and that becomes US natural gas. And that's all very clear. So we love all that stuff. And that's easy for us. Oil and refining is just much more tricky at the moment because of this whole tariff, where are we going, what's going on, the whole dynamic on how tough are you going to be on Russia, how soft are you going to be on Saudi, how tough are you going to be on Iran, how tough are you going to be on China is just impossible. And those are like the 4 biggest moving parts in the world oil market. So that's a tough one. And then, people love the midstream energy, right? Because obviously if you're going to get a lot more volume, which is implicit in a lot more natural gas, it's not even implicit, it's explicit. You're going to need a lot more volume of natural gas. Kinder Morgan's talking about growth of 28 BCF a day over the next 5 years, which is off a base of 100 BCF a day. So a 30% increase in what is already the biggest gas market in the world. You're going to need a lot more pipes. And so people are buying things like Kinder, and we think that makes a lot of sense.
All right, Paul, it's great to have you, especially here on set. Thanks so much for taking the time to join us.
Sure, it's a pleasure.
All right, coming up next, we are taking a look at today's Yahoo Finance's top trending tickers. We'll give you the news behind the moves, some of today's biggest stock movers. We've got that for you coming up next. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, chip stocks are rising. Broadcom, one of the biggest gainers in the NASDAQ on the back of Mark Zuckerberg's announcement that Meta is going to be investing between $60 billion and $65 billion in CapEx related to AI this year. That was well above what the street has been forecasting there. You're seeing a bit of excitement play out for some of those chip names. Again, Broadcom amongst the leaders here. You've got ARM just above the flat line here. But again, what this is indicative of, and I put that question to Dan Ives from Wedbush last hour, Maddie, and I was just talking about the fact that whether or not this is a start maybe of what is going to be more to come this earnings season. When you talk about the spending from some of these tech giants, especially the hyperscalers, what that planned spend is going to be, much of that has been scrutinized in terms of, or very much looked at from the street as a key catalyst and growth driver here for obviously so many of these tech names and chip specific names over the next several quarters. But again, when you take a look at the announcement that we're getting from Meta, Ives making the case that this is just the start of what we are going to hear from so many of these tech giants, and AI spending is here to stay. It's a priority here for so many of these companies, and very much that story, what we have heard over the last couple of quarters, is going to stay intact this earnings season.
I think it's interesting that Ives is saying that we're going to hear more announcements like this because of how weird this particular announcement was. Zuckerberg going on Facebook, making this post, and if we have the quote, I want to pull it up right now so we can take a look for our audience here. But he announces this on Facebook a week before his own company earnings. Why is that? This is exactly the type of thing you'd usually say in an earnings call, but instead he took matters into his own hand with the post. So it's going to be interesting to see if we see more of that from these tech executives. And here you see this quote, Meta building that 2 gigawatt data center, planning to invest 60 to 65 billion in CapEx this year while growing our AI teams significantly. That last comment too, I also thought was interesting given that just a couple Mondays ago, we had Meta announcing those layoffs of underperformers. Are we going to see them devoting capital a little bit differently internally as they look to hire more AI expertise and bring those kinds of workers on board as opposed to having what they see as underperformers as they go into this AI transition?
Yeah, certainly. And as you're talking here, I'm just taking a look at the quick reaction that we're getting from others on the street. Very much they are upbeat just about these spending plans. And I was curious about that because we've seen a bit of a different reaction, at least play out from the street when we've seen some of these CapEx spending plans exceed, very much exceed what the street has been looking for. But in terms of what this means for future growth, Stifel basically making the case that, yes, it was at the high end of investor expectations, though they do imagine that plenty of folks were at the north of that range. Vital Knowledge went on to say that they think it's going to be okay because revenue, if Meta's revenue forecast is as far above plan as the CapEx was, then investors are obviously going to be happy. So they're going to be able to maybe look past some of the immediate or shorter term spending plans that could potentially or would have potentially caused a little bit of discomfort maybe from some shareholders.
Yeah, especially after all of that efficiency from Meta, seeing more spending perhaps seen as a boon for a lot of AI names this morning. All right, next up, the maker of Guinness and Johnnie Walker, Diageo, is exploring big changes according to Bloomberg. The company considering a sale or spinoff of its Guinness business and reviewing its stake in LVMH's drinks unit. Diageo looking for ways to spark growth after seeing sales in the U.S. and China slowing last year. That stock up over 4%. It's interesting, though, that they're weighing these options for this Guinness brand, particularly in the context of the company reducing their medium-term guidance. Seems like they have been struggling under the weight of, all of the things that we talk about all the time. Inflation making consumers buckle. Also, the fact that they do have so much exposure to LVMH, around 30% stake in MH since 1994 here. They've talked about interest in acquiring Moet Hennessy, of course, one of LVMH's brands previously. Now, interesting to see whether or not a full acquisition could potentially put too much strain on the company's balance sheet. And perhaps that's why they are seeking out some optionality for this beer brand.
Yeah, we have a relatively new CEO at the helm, and they're just about a year and a half. But when you talk about some of the underperformance that we have seen from Diageo's brand, maybe this is going to be that key thing to unlock some of that growth that has been missing as we take a look at some of those longer term charts up on the screen here. But in terms of what this could mean, we saw the initial reaction. Shares actually popped almost 7%. We were looking at the biggest intraday jump, just to put this in perspective there for our viewers, the biggest intraday jump that we have seen now in just about 4 years. We're now off of that just a bit, up about 4%. Very much though unknown. It was important to point out that no, obviously final decisions have been made here. There's some question just about whether or not this is, even some of these deliberations, if this is going to lead to any of these deals and what exactly that roadmap looks like here for Diageo. But again, when you talk about not only Diageo being under pressure, the industry as a whole being under pressure, when you talk about the younger generations are not only drinking less, but drinking a little bit differently just in terms of their patterns and what we have seen from older generations. And many of these companies have had to pivot their strategy just a bit. So again, Diageo will be important to watch how this all plays out, and also just what that interest, if they were to sell it off, what that interest is going to look like for a brand name like Guinness.
Yeah, really good point.
Finally, shares of British fashion house Burberry higher after reporting a shallower than expected decline in sales. They were down 4%. Analysts were actually expecting a 12% drop. The company is undergoing a revamp. The CEO saying that he is encouraged by consumer response to the new lines, but there's still work to do. You're looking at gains of just about almost 10% there here for Burberry. The sales in America is unexpectedly climbing. China, though, falling just a bit, coming in just below the street's expectations here, looking at gains just about 9%. So off the highs of the morning, they have been up about 16% earlier here. But again, when you take a look at the road ahead, especially some of the troubles here in China, very much pointing to the fact that there is a lot to be encouraged about in this report, but some of those more challenging underlying stories here within some of these luxury consumer names is still continuous of a pattern that we've seen here in recent quarters.
And it's interesting because this also helped lift European equities more broadly, which have been under pressure from some of these luxury names, which of course, as you mentioned, Sean, are really under pressure from